If you're self-employed, a small business owner, or an independent contractor, and you want to get more money into your Roth IRA, I'm going to show you how to do it without increasing your taxes using your traditional IRA and your traditional 401k. We're going to get more money into the Roth side. What's going on, guys? Welcome back to the channel, or if this is your first time at our channel, welcome to the channel. My name is Travis Sickle. Now, this is a strategy that I don't know if I've actually seen anybody show it. Now, there's going to be parts that are going to be similar to using like the non-deductible contributions into the traditional IRA for the Backdoor Roth, and then we can look at the mega Backdoor Roth. But there are a couple of things that most people are unaware of in order to make sure that they're getting the most over to the Roth side, but not increasing their taxable situation and also driving down some of that reporting requirements that you might run into. So let's go ahead and start at the very beginning. So with the Roth IRA, you probably already know that if you want to make a direct contribution, the most you can put in here is $6,000. And if you're over 50 or 50 and older, you can do an additional $1,000 as a catch-up contribution. But if you earn too much money, then you can't make those contributions directly into your Roth IRA, and you're probably already aware that you have to make a non-deductible contribution. So here are those income limits that we will be looking at for the Roth IRA. For the Roth IRA income limits, we run into what's called a phase out. So if you're single or head of household, that phase out begins at $125,000 and goes to $140,000 for 2021. Those numbers will go up. Now, you can still make this contribution all the way up until your tax filing deadline in 2022 for 2021. Now, here is where the phase out begins. So what this means is that if you are earning this amount or less, this is your modified adjusted gross income, then you can make the full $6,000 or the additional $1,000 contribution directly into the Roth. But as you move closer to the phase out, which is $140,000 for 2021 and $144,000 for 2022, then you can't make a direct contribution. So the alternative to doing that is making the non-deductible contribution. Here's where the strategy is going to come in. So let's go ahead and talk about that Roth contribution. So if we make that Roth contribution into starting with a non-deductible contribution into the traditional IRA. Most people get confused. This is a non-deductible contribution. There's no such thing as a non-deductible IRA. It's a non-deductible contribution into the traditional IRA. And from there, we can then convert it over to the Roth. Now making that non-deductible contribution is an after-tax contribution. So it's the same thing as making a Roth contribution, where it's from your checking and your savings account, you go directly into the traditional IRA, and then we want to convert it. But here's another issue that you're gonna run into. It's also called the Pro Rata rule. So what that means is if you already have existing pre-tax money in your traditional IRA, maybe you rolled it from an old 401k, 403b, SEP, simple, something like that, or you made a contribution directly into your traditional IRA, that is pre-tax money. Now, you can't just pick and choose. You can't just take the non-deductible contribution that was already taxed and convert it over. You have to take an equal proportion, pro rata, of the pre-tax and the non-deductible parts. So there's a loophole that you can work with if you're an independent contractor, small business owner, or you're self-employed and you have no employees or no full-time employees. It's a solo 401k. Now, if you take your solo 401k and you take all that traditional IRA money and roll it into the traditional side of your solo 401k, then guess what? There is no more pre-tax money inside of the traditional IRA, and you could take that non-deductible contribution and then make that conversion. Now, you have to do this in the correct order. That means you need to take the money out of the traditional IRA first, then make the non-deductible contribution, and then immediately convert it over to the traditional IRA, and then convert it from the traditional IRA over to the Roth IRA. So now that you have that out of the way, the second thing that we want to pay attention to get the maximum amount in our Roth accounts is with the solo 401k. And this is going to be looking at the mega Backdoor Roth conversion. Now, in doing so, there's something very, very important that I have not seen anywhere else, so you're going to want to pay attention to this. So right here, we're taking this money and we're taking the pre-tax money and going to our solo 401k, and this is going to be our traditional side, just the same as the traditional IRA, and then you're going to have the Roth side of that solo 401k. Now you can do the same transaction. There's no pro rata rule here. So you can just go ahead and make that contribution as a non-deductible contribution into the traditional side of your 401k and then convert all of those dollars over to the Roth 401k. You can also do $19,500 as an employee contribution for 2021. That's going to go up to $20,500 as an employee contribution directly into that Roth 401k. And there are no income limits, so it doesn't matter. But if you want to get up to the maximum amount, you then have to make that non-deductible contribution into your solo 401k and then convert that. Now for 2021, that maximum is $58,000, and that goes up to $61,000 in 2022. So what this means is that you can make an employee contribution up to $19,500 for 2021 or $20,500 for 2022. But to get up to the $58,000 for 2021 and to $61,000 for 2022, you need to make a non-deductible contribution to the traditional side. But there's going to be another problem that you're going to run into. So as we're bringing all of this money in here, we're making a direct contribution into our Roth 401k of $19,500 or $20,500 if it's 2022. This is the max employee side, but to get up to that 58 or 61,000, we make the non-deductible contribution into the solo 401k and then take that non-deductible contribution and convert it over to the Roth 401k. No pro rata rule in a 401k. That is just with the IRAs. But because we're going from the traditional IRA and putting more money in here and we're funding it so heavily with the Roth 401k, the issue that you're going to run into is the exemption to file the Form 5500. So there is a loophole that you can avoid filing the Form 5500. Not that it's complicated, but it's just one more thing that you don't have to worry about. And if you forget to do the 5500 and you're required, it is a hefty or potentially a very hefty fine. So right here on the IRS's website, we can see that a one participant 401k plan generally requires to file an annual report on Form 5500 EZ if it has $250,000 or more in assets at the end of the year. A one participant plan with fewer assets may be exempt from the annual filing requirements. So what is this other loophole? All you need to do then is then take the money from the Roth 401k, the solo Roth 401k, and roll it over to your Roth IRA to help keep the plan assets below $250,000. Now, if you're like me and you are also making contributions for your spouse, it's very easy to get over those thresholds. And the reason that I'm pointing this out is because it is you and your spouse. It's all the plan participants and all of the accounts in that solo 401k. So you would add up your solo traditional 401k, your solo Roth 401k, and your spouse's same accounts. Add them all together on 12/31 at the end of the year, and that has to be under $250,000 in order to get the exemption and not to file the Form 5500. And there is one last caveat to all of this, that you need your own plan documents in order to make the non-deductible contribution into your solo 401k. It's a part that I've seen overlooked quite a bit that nobody really talks about, that the solo 401k can take non-deductible contributions, which is true, but you need that provision. It's basically just a paragraph in your plan documents that says you can make a non-deductible contribution and then you can convert it over to the Roth. And you'll also likely need to fill out your own 1099-Rs with the solo 401k as you're doing the conversion and also the distribution. Really important that you pay attention to the correct filings while you're making these transactions. But at the end of the day, this is a way that you can get a lot more money in the Roth side of your retirement plans without adding additional taxes from the Pro Rata rule and also avoiding the Form 5500. Hopefully this has helped. If you have questions, let me know in the comments down below. And if you've enjoyed this video, be sure to subscribe and leave your comments down at the bottom.